Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. In this video, we are just going to be diving into one of the simplest yet effective tools in trading, and that is none other than the 20 EMA. Okay, basically it's the exponential moving average that is set to period 20. Okay, so I'm just going to add the moving average to the chart right away. Now, if you have been struggling to identify trends, find the best entry points, or avoid false signals, then this video is for you, okay? Stay tuned because by the end of this video, you'll have a solid understanding of how to use the 20 EMA to make smarter trading decisions, all right? But before we jump in, make sure to hit that like button and subscribe to the channel for more powerful trading strategies every day. Okay, so let's just quickly get started. Now, what exactly is the 20 EMA? What exactly is the 20 EMA? Now, EMA stands for exponential moving average. All right, and compared to the simple moving average, the EMA, compared to the simple moving average, the EMA reacts more quickly to price changes. Right, the EMA reacts more quickly to price changes. Now, the 20 EMA is actually a short-term moving average, right? It's a short-term moving average, meaning it helps traders identify recent trends faster than longer-term moving averages like the 20, like the 50 EMA, okay, because the 50 EMA and the 200 EMA are longer term moving averages. So in simple terms, the 20 EMA helps traders determine whether the market is in an uptrend or downtrend or ranging. If the price is consistently above the 20 EMA, it signals an uptrend like what we have here, right? If it is below the 20 EMA, we have a downtrend. And if it is constantly crossing the 20 EMA without a clear direction, then the market may be in a consolidation phase. So now, based on those descriptions, we can see that this is a consolidation phase, right? And then we can see that we actually had an uptrend here as the price was above, trading above the moving average. And then here you can see that we had a downtrend as the price was trading below the moving average. You can see this is another uptrend. You can see that we have an uptrend here as the price was trading above the moving average, right? Now let's talk about how to actually trade using the 20 EMA. There are several ways traders use the 20 EMA, but let us just focus on the most effective strategies, all right? And the first is trend following strategy. The most common way to use the 20 EMA is as a dynamic support or resistance level. In an uptrend, in an uptrend, traders look for price pullbacks to the 20 EMA as a potential buying opportunity, like what we see happen around here, around here, around here. So those we are buying opportunities as the price pull back to the 20 EMA before bouncing back up. Okay, then the reverse is the case for a bearish trend. When you have a bearish trend and you get a pullback towards the 20 EMA, those are potential sell opportunities. All right, now let us talk about another strategy that you can use with the 20 EMA, and that is the reversal strategy. the reversal strategy. So another way for using the 20 EMA is for spotting trend reversals. When the price crosses the 20 EMA from above and stays below it, like what we can see here, initially we were having a bullish trend, right? And then the price crossed below it and stayed below the moving average. So in that case, we have a trend reversal, a bearish reversal. So the same applies for the opposite direction. If you have a bearish trend, and then you have a bearish trend, and then the price breaks above the moving average and stays above it, then you have a bullish reversal, right? So a lot of traders actually make mistakes when using the 20 EMA because they don't combine it with other factors. So here are a few things to keep in mind. Don't trade every cross. Just because the price crosses the 20 EMA doesn't mean that it is a strong trend, or rather a strong signal. Okay, so always look for confirmation from price action or other indicators. It's very important. And also avoid trading in ranging markets, right? When price is constantly crossing the 20 EMA without a clear direction, just stay away from the market, right? It is better to wait for a breakout. And then finally, use multiple time frames. Okay, a setup that looks good on the 5-minute chart might not align with the trend on the 1 hour chart. So always check higher time frames before making decisions, right? So it's important to use multi-time frame analysis. Okay, so to sum it up, the 20 EMA trading strategy is a fantastic tool for spotting trends, finding entries, and even identifying reversals. Okay, but remember that no strategy is foolproof. Okay, no strategy guarantees profit. Yes, in as much as we have effective strategies, there is no strategy that is 100% accurate, that guarantees 100% profits. Okay, so always pay attention to risk management. Do not trade with an amount that you cannot afford to lose, and do not neglect the importance of good risk to reward ratios. All right, ensure that you always observe good risk to reward ratios. For example, if you are risking $1, your potential profit target should be perhaps $2. That's going to be times 2 of your risk. Your reward times 2 of your risk. That is 1 to 2 risk to reward ratio. Okay, it is important. Now, also remember that the 20 EMA ought to be used as a dynamic support and resistance, right? And then you should always look for pullbacks. Make sure you always look for pullbacks in the trending market, okay? Because it's the pullback that you are trying to ride, right? After the pullback, you enter a buy trade if it's a bullish trend. Right after the pullback, you enter a sell trade if it is a bearish trend. And also avoid trading in choppy markets or sideways markets. Okay, and finally, always use confirmation signals before entering a trade. It's important to always get confirmations, right? For example, if you want to use other technical indicators for confirmation, you can choose whatever indicator you want to use, but just ensure that it's advisable. Ensure that you get confirmations to your signals before you enter a trade. So now if you have a breakout to the downside, for example, let's say that let's say we are having a buy trend initially, like what we have here. We are having a buy trend, and then suddenly we had a breakout, a bearish breakout, right? So it's important, if you confirm, in as much as the price broke below the moving average, and even if you use trend line, because it's also important to use trend lines, because the trend line also confirmed that bearish breakout. In addition to that, we also had a confirmation from the RSI. As you can see, the RSI was dropping down from close to the overbought territory. So it's important to always get confirmations for your signals. If you found this video helpful, make sure to smash that like button and subscribe to the channel for more trading strategies. Also, let me know in the comments what is your favorite moving average strategy. I'd love to hear your thoughts. In the meantime, thank you for watching, and I hope to see you in the next video. Happy trading.